small receipts. You have to keep anything over $75 is required. Anything below $75, you don't have to have documentation. But you have to have good document. You have to keep documents. You have to keep receipts. You have to keep invoices. You have to keep contracts. You have to keep W-2s, payroll records, right? And it's good to have all of these organized and into a good system. So one of the things I try to tell my clients is people always get to the end of the year and they go, oh, well, it's tax time. Why don't I start gathering all my tax stuff, right? Well, I say don't do that. You know, do it as you go throughout the year, right? Make it part of a business process, because then I'll get into that a little bit more later in just a few minutes. But make it part of a process so you know what you're going to need to give for the tax time at the end of the year. So, you know, create a little system that allows you to gather that as you go through the end of the year. Oh, we bought a new asset. Here's the invoice. I know the CPA is going to want to see that. Or the bookkeeper, right? So keep that, and then at the end of the year, you just give it to them, right? You don't have to go through and make it another process. And then here's a big one. Never commingle personal and business funds. That is a strict no-no. So a lot of people go, well, it's my business, it's my money. Well, that's true in some regards, right? But there's a lot of things that can do from not only a tax standpoint, but from a legal liability standpoint that could harm you as well. So do not commingle your business. I know that people love to run personal expenses through business. I do. I hope I never get audited, but any wood. So just don't do it, right? So never commingle expenses. All right. So record keeping very important.
Josh?
Yep.
Oh, sorry.
You
have to, like the receipts, Gabrielle got me out of holding receipts. I didn't think they were required if it comes through the bank and it's on the bank.
Great point. So bank statements and credit card statements are not substantiation under an audit. Okay? So let's say you go to Best Buy and you spend $2,000, right? Throw the receipt away, and the IRS comes in and audit and says, what's this Best Buy $2,000 for? Well, I bought this stuff for the business. Well, how do we know some of it didn't make it home? You know what I mean? So, yeah, so you got to keep receipts.
But the modification on that, if you use QuickBooks, you can attach it.
Yeah.
So if you're doing a $1,000 computer for your business, that receipt from Best Buy, just attach it in QuickBooks transaction or grab it, give it to your bookkeeper, they can attach it, and you have the record.
Okay, good point, thank you. Okay, so never commingle expenses. I'll just leave it at that because it's very important. So hiring the right tax preparer, right? Your tax preparer should be a strategic partner. I do not work, so there's two types of CPAs, right? There's a CPA that prepares returns, and there's two CPAs that have relationships with their clients and prepares returns, right? I do not just prepare returns. That's why I don't work with a bunch of individuals. I work with business owners and help them maximize the value of their business and minimize their tax liability. Because 90% of small business owners' wealth is tied up in their business, and the most expensive expenditure that a small business owner will make is income taxes, right? So that's why we work diligently to make sure that it's a relationship. And it also sets expectations, and it's also a planning process as well, right? We'll talk about that on the next slide. But look for credentials, right? EA is an enrolled agent. That's someone that's certified by the IRS. They have to have continuing education. They have to have compliance and checks and balances with the IRS every year. They are allowed to represent you in front of the IRS. A CPA is certified public accounting. It's licensed by its state board. Also allows you representation in front of the IRS. And then a JD and an attorney. Some attorneys do prepare tax returns as part of their services. So you'll see a lot of tax firms that do litigation and resolution. Will also have a compliance department as well. So I'm not gonna say anything disparaging about any tax preparer, but I would not use a tax preparer that did not have some sort of credentials. Right? That's just me personally. EAs, enrolled agents, you'll find that they're typically more tailored to individual tax returns. They're not really a lot of accountants per se, like traditional general ledger accountants and business accountants. So you'll find that some do businesses very well, but the majority of them stick to individual returns. And a CPA is where you'll get into the business and individual, and JD typically is where you'll see into trust and high net worth individuals, right? So that's kind of, and most attorneys don't do tax compliance work, but some do. All right, check the referrals and history, verify licensing and past performance. So there's a NASBA, National Association Standard Board for Accounting, National Accounting Standard. That's it. So you can verify any CPA license on that website. So if somebody says I'm a CPA, I mean everybody wants stolen something these days, so verify, right? make sure that it's current, there's no claims against it. You can do that with an EA as well. Assess the working style. Are they proactive or modern, right? So shoebox, anybody heard the term shoebox? They started with shoebox. We don't do shoebox, right? So I literally had a client come in one day with a shoebox and no sir, sorry, that's not gonna work for us. So, so are they modern and proactive, right? Do they only contact you in January, say it's tax time, right? Are you sending them information via mail, right? My clients, we have a complete portal system. Everything is 100% electronic in the cloud. You don't even need a piece of paper to do a tax return at my firm, right? So, and do they communicate well, right? And do they understand your industry and unique challenges, right? So, small businesses are small businesses, right? But every small business has some unique challenge. For construction companies are great, bankings are great, automobile dealerships have their own unique challenges because they have LIFO inventory. All right, so do they understand your unique challenges? So when I go market, I just say I'm a construction CPA, and that works well because I focus on the things that matters most to construction companies. Now they may not matter most to a retail store or a gas station, right? So it has to be particular to your industry. It doesn't have to, but trust me, it's more advantageous. I can tell you, when I take over a construction company from another accountant, it's a night and day difference, right? Short and long-term strategies. All right, so I'm going to make you interact with me here for a second. How many of you file tax returns? Everybody. Good, that's what I would expect. How many of you do tax planning? Yep, so a very small percentage, okay? So tax planning is one of the ways I get most of my business, right? So, you know, I've had people like, how do I refer you business, Josh? I would say, well, if you're talking to a small business owner, ask them if they do tax planning. And if that answer is no, that's the best introduction you can give them, okay? Because it's a process. You need to make it part of your business process. You have the revenue cycle, the payroll cycle, the payable cycle, the cash conversion cycle. You've got all these different cycles in your business, and then people go, oh, well, just taxes is compliance. Well, that's not true. It is a process. It needs to be a business process. And the best way that I can do that is to tell you just kind of how I work with my clients. It's not a sales pitch, but it's just compare and contrast, right? So the way that I work with all of my clients, my small business owners, is it's not a, hey, it's tax time, give me your information, let's prepare your return. I make them what I call it a program, right? And I go, okay, it starts in August. And I reach out to all my small business owners in August and say, hey, how's it going? You know, how's the year going? Are we making money? Do we have a tax situation that we need to plan for? What does the rest of the year look like? Are we going to make money? And then we go, okay, we forecast what the business is going to be for the year, and we take into consideration what all the transactions have transpired that would affect the tax situation, and then we do a projection from that forecast of the business right down to the owner's individual tax situation, and we go, okay, that's October 15th, and this is what your tax liability is going to be for next year, right? Now, before the end of this year, what decisions can we make to minimize that tax liability? Do we want to bonus employees, profit sharing contribution, go buy more equipment? You know, what are the decisions that we need to maximize our current deductions? What available tax credits are available, right? The EV credits have gone away. So solar credits coming out for 2025, right? Can you invest in solar credits and offset your tax liability? Sure. There's other credits, state credits, low-income housing credits, film credits, so you can offset your tax liability. And then optimizing the timing of income and expenses. So what we do in the construction industry is we call it tax and bond planning, because you want to maximize your financial statements so you can get credit from your bonding and banks while minimizing your tax liability. But now let's take that to a smaller business, not a construction company. We go, okay, now we have a cash basis taxpayer. We're running at the end of the year, close to the end of the year. We go, okay, we got all this cash in the bank, we got all these payables. Maybe we start paying some bills early before the end of the year, just so we can knock off that income in December. Sure, we're going to trade it over and flip it over in January. The whole tax game is kick the can, right? So we just don't want to pay the debt. Obviously, we'll have to pay tomorrow. Maybe we die and don't have to, right? So that's the ultimate goal, right? So. But they're also, so that's part of the short term is every year you get together. So, you know, I have a client this year, they bought a building, right? So I know that they bought a building 2 months ago, so we're going to get a cost segregation study done on that building before the end of the year instead of after the end of the year. So that way we can still file on time. Does that make sense? So, and then you have to have long-term strategies, right? So not everything is about not paying the tax man, right? So there's a phrase called "Don't let the tax tail wag the dog." Anybody ever heard anything like that, right? So what you'll see a lot of small business owners do is they'll run as much as they can through that business, right, and minimize that tax liability, which is not a bad thing. But in some regards, that can limit you, right? And you know, Carl and Ann will tell you later, if you're trying to sell your business, that's probably not the best strategy, right? Because it's based off earnings, future cash flows, and you want to maximize that value. But also, you know, you may not even be able to get a house sometimes, right? So I've had small business owners come and say, hey, I didn't pay any taxes last year. Now I want to go get a home loan, and the bank won't approve me for a loan. And they come back to me and say, well, can we amend my return and eliminate all the expenses? And I say, that goes against my very existence. You know, so there's no, that's not going to happen. So, you know, you want to be aggressive to a reasonable standpoint, but you don't want to be overly aggressive. And the term that everyone uses is what is ordinary and necessary. It's in the tax code. I didn't make that up, right? So what is ordinary and necessary for your business, and then push it just a little, and then you'll be fine. But you don't want to just totally get that income number down where you can't get a line of credit, you can't get a loan, you can't get a house, you can't sell your business, right? There's ownership transitions, right? So you're always looking down the road. Is somebody leaving? How are we gonna get them out of the business? And then you have investment growth too, right? Thank you. So you have investment growth too, in that, you know, if you're continuing to maximize that or pull the money out of the business, or, you know, spend it to be able to minimize taxes, it could limit your reinvestment back into the company for growth. So I would always recommend a small business owner, make it a part of your process, right? So you should be reaching out to your CPA every fall and going, all right, let's start this planning process so I can know how, basically, one of the main reasons you do it is so you know how much money you get to keep, right? That's what's most important to the small business owners. At the end of the year, you've made all this money and you have 3 people you have to give it to. You have to give it to the IRS, you have to give it back to your company, and you want to give it to yourself. So at the end of every year, you want to be able to plan to maximize how much you give to yourself. That's why we all work, right? So again, don't let the tax tail wag the dog. Prioritize financial health evaluation alongside tax savings. All right. New tax law changes. I think they're going to send the slides out after. If you click on the link that says read more, the big beautiful bill came out. There's a taxfoundation.org. They always do independent analysis, so it's not skewed either way. But they have a great article called The Good, the Bad, and the Ugly of the New Big Beautiful Bill. So if you want to read it, read it. There's a lot of good things in there, right? So I'll give you an example. They want to bring manufacturing to the USA, right? So if you're in these manufacturing list that they want back in the USA, and you start a brand new building and you complete it within a certain amount of time, you can write that building off in the year that you place it in service. To contrast that, most buildings have to be depreciated over 39 years, right? So that just tells you they're giving you a 39-year advantage of depreciation. That's how badly they want to bring the manufacturing back to the U.S. All right. So again, there's also stuff in there about let's see, the Social Security, the depreciation, bonus depreciation for this year was supposed to be 40%. So at the end of last year, you started seeing less investment, but now from anything purchased from January 20th on is eligible for 100% bonus depreciation. So that's good, right? So we go out and buy assets and write them all off. So there's a lot of good things in this bill. So just read through it and see what applies to you and how you can take advantage of it. I got a 2-minute warning, so I'll just stop for questions. Is that good?
Yeah, that's good.
Awesome. Yes, sir.
Real quick question. Let's assume in year 1 I choose cash basis for reporting to my taxes, tax return. In year 2, I realize, oh, crud, I should have chosen accrual because in year 2 it gives me a better answer. Can I change to accrual in year 2?
You can, but they're not going to let you change from year to year.
Okay.
Right? So you can't go back and forth. Once you make the change, right? And theoretically, you're making a change for a purpose, right? So, and that's one thing that we do in the tax planning phase is if they're on the cash basis, we always do that conversion to see what's more advantageous because it's not, the cash basis may not always be advantageous, right? Because in construction, especially for general contractors, right? Subcontractors are different because they pay for their own labor most of the time. But for like general contractors, they do a lot of billing in advance, which means they collect a lot in advance. right? So we switched them over to another basis, so they're not paying on money that they're gonna spend for a project. Make sense?
Got it.
Anybody else? Yes, sir.
So when it comes to deferring taxes,
Yep.
right? It's not saying you're not going to pay taxes. You're saying you're not going to pay it this year. Is that right? Is that kind of the concept?
Yeah.
And then you can push it off until you decide when you want to pay, or decide like.
It's always the kick the can, right? So how much can we not pay this year for next year, right? So for example, if I'm a business and I go out and I buy a new vehicle, right?
Yep.
Statutorily, I can depreciate that over 5 years, okay? Or I can write it off this year, right? So I've made my money this year. So if I write it all off this year, I minimize this year's liability, but I've sacrificed next year's liability.
But next year you can buy another car, though.
Exactly.
Oh.
You're just kicking the can.
Gotcha.
See what I'm saying?
Gotcha.
Thank you for moving.
Yeah. Just seeing what's.
Anybody else? Yes, sir.
So Josh, and this is more for you and Gabrielle and Chris, if your client is giving you monthly financial statements, quarterly financial statements, how often do you feel that they should track their financial statements? Is it monthly, is it quarterly, is it semi-annually, is it annually?
Well, I think I started the very presentation with it depends, right? So it depends on your business. It depends on your cash situation, right? If cash is always tight, you want to look at it weekly. It depends if you're in a construction company, how quickly you finish your jobs, right? You may want to look at labor weekly instead of monthly. But if it's a big job and you're a general, maybe monthly, right? But I would say at a minimum, at a very minimum, you should be looking at your financial statements every single month,
Yeah.
without question.
Yeah, monthly.
And I ask that for a purpose,
Yeah.
right? I think it's important for everybody to understand.
Well, unfortunately, you'll see a lot of small businesses, they will not place the correct amount of emphasis on the accounting part of it. And it never benefits them, I can tell you that. It always puts them in a situation where they're paying more to fix a problem than to pay to do it right the first time. Or, it's just become a headache and a crunch situation. So, for the value that you receive from outsourcing your accounting, it is a no-brainer for any small business.
Can I add something to that, to answer to that question? You answered monthly, but let's talk about why. If you, for every month you don't look at it, if something's going wrong, expenses are high, do you want to wait 3 months before history's written? You want to realize you were losing money for 3 months, or you should have increased prices for 3 months? That's money that would have went in your pocket because you waited 3 months, 6 months, 1 year before you detected the problem. So the reason why monthly, we're not just saying give you work, it's the only way you can problem solve what's going on financially in your business.
It's
And you
monitoring.
can also look at, if you're looking at it every single month, everything, you'll remember what happened in the last 30 days. But it's hard to remember what happened before. So for our clients, we give them to monthly. And then when you get to January, you just give Josh your financials and he goes with it. So it's good to look at it just on a monthly basis, close the books, lock the books, be done, and then you don't have to worry about it.
And I could give you 25 years, I've seen some horror stories, right? So, and I see it a lot in construction because, construction is a unique industry, but I had a company 1 year and they weren't doing monitoring. They weren't even doing their accounting. They were just focusing on the jobs. And when I did the review at the end of the year and the test engagement, they lost $6 million and didn't even realize it.
Wow.
Right? And I can tell you many, many instances like that. And the way that I explain it to the contractors is like, okay, are you going to do a job and then evaluate your financial performance? Well, how did we do on that job? Well, you need to know that before the job is over, right? So kind of the same way with your business. You need to know how you're doing before the end of the year.
Last question, on that $6 million loss, did they have to pay taxes?
Huh? They didn't have any money.
That's the way to avoid taxes.
They almost had to shut the door. Well, let me close on that. Though the funniest thing to me is, how can I pay less taxes? Well, I'll just make less money. No. All right, I'll end it up. You'll have a great day. Thank you very much.
Yeah.